Most people assume their bank account is a neutral storage mechanism, a place where value sits, waits, and remains intact until it is needed. That assumption is structurally false, and the gap between that assumption and reality is widening. The mismatch is not between price and liquidity. It is between the perception of financial security and the architecture of the system providing it. Bank deposits are not stored value. They are unsecured loans to a leveraged institution, governed by a legal framework that prioritizes systemic stability over individual claim. The depositor is a creditor, the bank is the borrower, and the regulator determines the resolution hierarchy if the borrower fails. This is not a fringe interpretation. It is the legal and operational structure of modern deposit banking, one that most depositors have never been required to understand. Because the system has, until recently, maintained sufficient institutional credibility to make the distinction irrelevant in practice. That credibility is not permanent, and the capital flows moving outside the traditional banking architecture are signaling that a structurally significant cohort of rational actors has begun to price that risk. Three macro forces are reshaping the incentive structure around traditional bank deposits simultaneously, and their interaction is not additive, it is compounding. First, the interest rate environment has exposed a duration mismatch embedded in bank balance sheets that went unexamined during the zero-rate decade. When rates rise rapidly, the mark-to-market value of long-duration, fixed-income assets held by banks declines. The depositor sees no change on their statement. The balance sheet stress is invisible until it is not. The 2023 regional banking failures in the United States, Silicon Valley Bank, Signature Bank, First Republic, were not idiosyncratic events. They were a structural demonstration of what happens when rate normalization collides with a balance sheet architecture built for a permanently suppressed rate environment. The resolution in each case involved either regulatory intervention or acquisition, both of which required the deposit guarantee framework to function at the system level. Individual depositor protection was, in each case, a policy decision, not a structural guarantee. Second, sovereign debt issuance at scale is creating a direct competition for institutional capital. When government bond yields rise to levels that offer meaningful real returns, the incentive to hold capital within the banking system is structurally reduced. Institutional capital optimizes. It moves toward the highest risk-adjusted return available within its mandate. The implication for bank deposit funding stability is direct. As alternative instruments become more attractive, the cost of retail and institutional deposit retention rises. Third, the regulatory trajectory across major jurisdictions is expanding the conditions under which depositor funds can be subject to bail-in provisions. The Financial Stability Board's total loss-absorbing capacity framework is designed to shift resolution costs from taxpayers to creditors, which, in a bank failure scenario, includes depositors above the insurance threshold. This is not hypothetical, it is the stated policy architecture. The structural implication is unambiguous. The risk profile of a bank deposit above the insured limit is not zero. It is a function of institutional solvency, resolution policy, and regulatory discretion. The structural implication for capital allocation, the assumption that bank deposits represent risk-free value storage, requires revision. The risk is low probability but non-zero, and in tail scenarios, the outcome is not gradual. It is discontinuous. The observable capital movements confirm that this revision is already underway among sophisticated actors. First observable signal, money market fund assets under management reached historically elevated levels following the 2023 banking stress events. This is not coincidental. Money market funds hold short-duration government securities, instruments that sit outside the bank balance sheet entirely. The shift from bank deposits to money market funds represents a structural preference for sovereign credit risk over bank credit risk. That distinction matters. It reflects a rational reassessment of the counterparty stack, not a speculative repositioning. Second observable signal, Bitcoin exchange-traded product inflows represent institutional capital accessing a non-sovereign asset class within a regulated structure. The significance of this flow is not the return profile. It is the asset class characteristic. Bitcoin has no issuer, no balance sheet, no counterparty, and no regulatory jurisdiction that can modify its supply or freeze its transfer at the protocol level. Institutional capital is not buying Bitcoin because it has abandoned discipline. It is buying it because the counterparty risk characteristics of a non-sovereign asset are analytically distinct from any instrument inside the traditional financial system. Third observable signal, self-custody adoption, measured through on-chain metrics tracking coin movements from exchanges to cold storage wallets, continues to trend upward during periods of banking system stress and regulatory uncertainty. This behavioral signal is not speculative. It is the revealed preference of capital that has made a deliberate decision to exit the counterparty stack entirely. The destination is not another institution. It is direct ownership, the elimination of the intermediary layer and all the risk embedded within it. The interpretation across all three signals is structurally consistent. Capital is not fleeing toward higher returns. It is repositioning toward lower counterparty exposure. The incentive is not greed. It is risk architecture optimization. The derivatives and on-chain data provide the behavioral granularity beneath these macro positioning shifts. First derivative signal. Funding rates on Bitcoin perpetual futures have demonstrated a reliable pattern, elevated positive funding during periods of speculative enthusiasm, compressing toward neutral or negative territory during periods of institutional accumulation. The divergence between speculative leverage and structural accumulation is meaningful. Speculative leverage reprices quickly and violently. Structural accumulation reprices slowly and persistently. Identifying which dynamic is driving price at any given moment is the analytical distinction that separates signal from noise. Second derivative signal. Liquidation cluster analysis reveals that the most significant forced selling events in Bitcoin's price history have consistently occurred at leverage ratios that exceeded the market's capacity to absorb at prevailing liquidity depths. The lesson embedded in this data is not about Bitcoin's volatility, it is about leverage architecture. Volatility is a property of any asset with an open price discovery mechanism. Leverage applied to that volatility creates discontinuous downside, the exact characteristic that is absent in a properly structured non-custodial position. First on-chain signal, HODL wave data shows a consistent pattern across cycles. During periods of price appreciation driven by speculative inflows, short-term holder supply expands as new entrants acquire and older holders distribute. During periods of consolidation and drawdown, short-term supply contracts and long-term holder supply expands. This supply redistribution dynamic is the structural fingerprint of conviction capital absorbing speculative supply. It is not sentiment, it is behavioral revealed preference at the coin level. Second on-chain signal, exchange reserve depletion. The sustained reduction of Bitcoin held on centralized exchanges has been a persistent trend across the current cycle. Coins leaving exchanges and entering self-custody represent a specific behavioral decision. The holder has determined that the risk of custodial exposure to a centralized institution exceeds the convenience of rapid liquidity access. That is a structural risk management decision, not a speculative one. The convexity insight is this: a non-custodial Bitcoin position has an asymmetric loss profile compared to a bank deposit in a tail scenario. The bank deposit can be frozen, bilaid in, or restricted by regulatory action. The self-custodied Bitcoin position, managed with proper key security, cannot. The expected value of that asymmetry is not priced into the surface-level comparison of return profiles. It is a structural option on financial autonomy, one whose value increases precisely when the system creates the conditions that make it most necessary. The framework for navigating a world where the bank account is not the only option does not require ideology. It requires structural clarity about what each instrument actually is and what risks it actually carries. A bank deposit is a short-duration unsecured loan to a leveraged institution, backstopped by an insurance mechanism with defined limits and regulatory discretion above those limits. It is the appropriate instrument for operational liquidity, funds needed within a short time horizon where the priority is accessibility, not risk optimization. A money market fund holding short-duration government securities is a structurally distinct instrument, lower counterparty complexity, no bank balance sheet exposure, liquid. It is the appropriate instrument for near-term capital reserves where the priority is stability and low counterparty risk within the traditional system. A non-custodial Bitcoin position held in cold storage is a structurally distinct instrument. No counterparty, no issuer, no balance sheet, fixed supply, globally portable. It is the appropriate instrument for long-duration capital, where the priority is preservation of value outside the monetary debasement mechanism entirely. The rational actor does not choose between these instruments. The rational actor structures capital across all three, size to time horizon, liquidity need, and risk tolerance, with the explicit recognition that each instrument carries a different risk profile and a different structural function. The discipline this environment demands is architectural thinking, not product selection. The question is not which bank offers the highest deposit rate. The question is what portion of your capital should be inside the counterparty stack, and what portion should exist outside it entirely. That distinction is not philosophical. It is the foundational question of financial independence in an environment where the architecture of the traditional system is visible, understood, and increasingly structurally stressed. This is 21 Protocol. Freedom is not a feeling, it's a structure. If you don't build yours, they will build over you.